Hi, this is Joe. We're going to go through some examples. I'm actually going to show you a few pages out of my book, and then I'm going to give you a few examples in today's market environment of stocks that are meeting the criteria and the exact pattern and setup that I like to use. That is a consistent pattern. It happens in all different time frames. You can look at it on the long side. You can look at it on the short side. You can look at it for longer term investing. You can look at it for shorter term swing trading investing. And I think it's what I consider to be, your goal is to find, I used to say like a low risk idea generator. Or you could call it like a weighted coin. You want to be able to flip a weighted coin that's going to come up more often heads than tails. So that's really the goal here. I'm going to go into a little bit of detail on the entry point and where I'd place a stop, and then give you an idea of what the target should, at least the ballpark of what the target should develop to be. So let's get into this. I'm going to start by talking about again, this is the table of contents from the book, and there's a lot of information. There's some introductory things that I think are really important, especially when it comes about page 33, where we go into 23, where we start talking about trend and changes in trend. But I'm really going to focus my time on the rules for multiple time frames and then incorporating moving averages. Which really, once we do that, then we find the setup that I'm really describing here. So if we go, this is page 61 in the book, and what I want to point out is that the red line would be the 18. I described this in other pages, but in this situation, the red line is the 18 MA, the blue line would be the 40, and that would be for the weekly. And then here are the two monthly lines. So this is kind of the combination. I've sort of put it all in one page and overlaid them together because I thought it was important for you guys to see this. I talk about this throughout many videos, but I think if you have an understanding of this particular pattern, I think it's the type of thing that you can sort of add and maybe use as a, even if you want to be a longer term investor and you're just doing it to buy ETFs, it'll really help you identify when you're getting opportunities to add to, say, your 401k, or potentially if you want to buy into some longer term stock you really like, say you want to buy Apple, but you want to do it at the right time. This is really a very good strategy from that standpoint. I'm going to give you some examples now. I just want to make sure you get a pretty good feel for what I'm trying to do here. So the first chart I'm going to use is Zoom video, and I've got a daily chart on the right and an hourly chart on the left. And so this is obviously would be for a swing trading tactics. I'm going to show you some longer term ones. I'm going to show you actually a short. It can be used a lot of different ways. So on the right side, we're always starting with the higher time frame. And again, if we go back and look at the longer term moving averages, in this case, I'm using on the chart in the book, I'm using monthly and weekly moving average lines. But again, it can be applied to any two moving average sets that you want, as long as there's like a 1-to-5 ratio between the two. So monthly, weekly works fine, weekly, daily. Again, the daily, hourly also works fine. It's more of like a 1-to-7, 1-to-6.5, 1-to-7 ratio. So it's a little bit different, but the moving averages are pretty much work in the same way. So what we're looking for on the higher time frame is this pattern where the 18 is above the 40 and both lines are rising. Now keep in mind, if you notice in the book, there were a lot, we can look at, there was several areas past this where we go into a lot of detail on different things using MACD and ADX to refine your technique. But let's just keep it real simple. And I'm not even going to use those qualifiers or those improving ways to improve your performance or improve your stock selection, or maybe to improve your entry a little bit. I'm going to keep it really simple. And again, what we're looking for on the higher time frame is the 18 above the 40 and both lines are rising. And so if you look at where the different spots, this is a spot, where that meets the criteria. This is actually a spot. Another one here. These are all where price has basically moved down towards or in between the 18 and the 40, and both lines are rising. And so that's the higher time frame. The lower time frame, we're looking for when the 18 crosses down below the 40, and then we're waiting for the first time. So I'm going to zero in. I'm actually going to just show you the most recent one. We're looking for a period where the 18 crosses down below the 40, and then price comes down underneath both moving averages. And then we're looking for price to cross back above the 40. So essentially you're both below both moving averages, and then you move back above both moving averages. And then your stop would go underneath this bottom, the last swing low on the chart. So if you think about it, I'm going to try and make this look a little. So the entry point is here, your stop is here. That is your risk. And what I've done here on the arrow is, for every one of these trades, is to show what 2 times your risk would be. So that's about 2R. If you look at R being risk, that would be you're risking about 2 times, or you're getting about 2 times what you risk. And I think that's a pretty good barometer as to whether that's a successful approach. I think you could be successful going for 1.5 to 1, but 2 to 1 really allows you the ability to to go through losing periods, or losing streaks, I should say, and still sort of stay above water. So I'm going to go back now. I just want you to look at this pattern, and I want to show you what the criteria I used for that signal, and gave you the details, took place at this arrow, at this arrow, at this arrow, and twice here. And the first time was a loser. You got in and you got stopped out right away. It went underneath that low. And then the second time gave you another entry. And again, I would put the stop down underneath here. And it's actually a little bit higher than that. And 2 to 1 would be somewhere up in this range. It's really a ballpark. I did it kind of quickly, but it certainly hit 2 to 1, probably hit 3 to 1. This one just barely got to the 2 to 1 mark. This trade here, actually, I didn't point the arrow to, but that was definitely another signal, and it got to 2 to 1. And so, each one of these are different signals. Now, we're talking about Zoom video, Zoom communications. It's been a very popular, very active stock, one in the news. And what I'm trying to get at here is, if you have a strategy, you don't have to listen to CNBC. You don't have to go, what is Jim Cramer telling you to do? Go have your own ability to go and look for patterns that meet the criteria you're looking for. Use stop losses. Don't risk more than 1% of your equity to the risk point. So let's say you risked 10% of the account in a specific trade. Don't risk more than 10% of that to the stop. So that's kind of how I look at it. Look at 1% of equity as your risk point, and then you're going to stay in the game. And you can keep finding these patterns. Let's just go take a look. I'm going to look at Weyerhaeuser real quick. I'm going to switch this now to a weekly. And on the left side, I'm going to show a monthly. So on the higher time frame, we've got the 18 below the 40, both lines declining. And so the criteria is met here on the higher time frame. This is kind of what we're looking for. And then if we go to the weekly chart, we're looking for, again, that opposite situation where the 18 is above the 40. Now, if you look here, it's where price is above both moving averages, and it stays above until it closes below at this point. And then you'd go and put your stop. So that's essentially, this here is your entry. Your stop would go above this previous peak. And then again, that would be 2 to 1 to the downside. Just as a note, I would say for short trades, I would be more aggressive in profit-taking strategies. I wouldn't be looking for big trending moves to the downside. I mean, you can get them periodically, but I think you're going to be much better served just trying. If you're going to do any kind of shorting, make sure your risk parameters and your targets are a little bit tighter. Try and play for smaller wins. Let's go and take a look at Apple. So I'm going to widen this out, zoom in a little bit. Again, so if you looked at the 18 and the 40 both rising, now this was losing a little slope, but it was still rising through this period. And then if we're looking at it right in this zone here, we go back on the weekly chart, and where both criteria is met is here. Right at this point, price crosses back below or back above both moving averages after being below when the 18 was below the 40. Now here's the problem I have. If you enter here, your stop's got to go all the way down here. So I think you have to take this into account. If you've got a risk, in this case it was something around 50 points. So what I would do in this situation is I wouldn't automatically put the stop at the last reversal low. You actually had a little tick down low here that you could have used. It wasn't really what I would consider to be a good solid bottom, but it did have a little bit of a hesitation there. And so, you could use that, or you could come underneath the 18, maybe give it a little breathing room under the 18. And use that as a parameter or a stop point. The second option is to say, I'm going to wait for the next pullback in this and wait for the first higher low to develop. And in that case, your entry would have been right here as the close of this big bar, and then your stop would go underneath this low. So, if we look at it from that standpoint, instead of risking whatever 50 points, now I've cut the risk down to say, 15 points. And in that case, it's a lot easier to go hit targets. And look at it from a risk reward standpoint, that's what this game is all about. Try and make more when you win than when you lose, and trying to have more wins than losses. But at the same time, I want to have the size of the wins to be more than when I take a loss. So that's the goal. So let's go and look at Netflix. So this is another example. I actually switched this to a weekly chart. Now I'm going to switch this to a daily on this side and keep the weekly over here. So here's where the 18 is above the 40. The 40 is starting to cup around right in this zone, and it's might not be rising quite yet, but it's showing the condition of the 18 rising, and this was right after the market crash. So to me, those are pretty good conditions in place from that standpoint. And then again, if we go to a daily chart, now I'm looking at it from on the daily chart. I'm saying, okay, I've been below, the 18 was below the 40, the price was below both, and then we closed back above right here. Now this is the same situation as Apple. So if you were to take this trade right at this point, your stop's got to go way down here. And you can do it that way. But if you took the trade, if you waited for the first higher low, you could have taken this entry right here where I've got this arrow pointing, right where this stock closed on this big green bar, and your stop would have gone underneath this low here. And your target would have been, well, 2 to 1 would have been here. I think you'd have probably gotten to 3 to 1. But the whole idea is that if you keep doing this, flipping this weighted coin over and over and over again, get to know this pattern. This is not a difficult pattern. I'm not saying trading is easy at all by any stretch. I don't think it is. But it can be simple. I think if you learn some simple rules using 2 different time frames together like this, the one time frame is telling you that the trend is either turning up or it's in an uptrend. And then the lower time frame is telling you that the trend has turned down and we're waiting for signs that it's turning back to the upside. Now, I think there's other criteria that you can use to improve your trading tactics, and that's a part of the book as well. But using the MACD, using the ADX, these are other criteria that can help refine the list and help you with your entry point. But I'm giving you a pretty simple way, I think, to implement this, especially if you want to do it from a longer term standpoint. I think you'd be surprised how simple it is. And I think it's going to help you evaluate where the market is. It's going to evaluate if a stock you're looking at fundamentally, you really like longer term, you want to get in, or if you're looking at an ETF you want to buy, it's going to help you with criteria. There's a couple times a year where you get really good entry points. This is good tactics to use. Please let me know if give me some comments. Let me know if this strategy makes sense to you or if you think it's too complicated. I'm trying to get a gauge of where the subscriber base is on this type of stuff. What types of things you're looking for. Make sure you post in the comment area so I can hear what types of things you'd like to talk about. All right. Thank you.